A retired math teacher from Noida named Ram Prasad Saxena sat down with a lifetime of savings, 25,000 rupees. Today, at 70 years old, that exact same pool of capital sits at 21 crore. He holds no MBA, and he never struck gold on a hot stock tip. Young traders often approach him looking for a shortcut. They ask for the next multi-bagger, scanning Telegram groups, WhatsApp chats, and Twitter feeds to find a 2-minute breakout setup that will double their money by Friday. When he talks to these younger investors, he notices a recurring pattern. They aren't actually looking for financial independence. What they are unconsciously seeking is the dopamine hit of the gamble. They want excitement. In the 1990s, selecting a company required requesting physical annual reports in the mail and reading balance sheets line by line. Saxena used to plot out historical pricing data by hand on a piece of graph paper. Deciding to put money into a single stock took 2 to 3 months of quiet, tedious work. Chasing new strategies to fix a failing portfolio is like saving a dying tree by spraying its leaves. To keep the tree alive, look underground. The root system is an investor's mindset and patience. If roots are dry, the tree will collapse. Look at the 1992 bull run. Euphoria took over the market, and everyday people felt like financial geniuses as their portfolios artificially multiplied. Wherever money is fast and easy, extreme caution is required. While the crowd leveraged everything they owned, Saxena quietly sold his positions at premium prices and moved his capital into cash, waiting for the inevitable correction. When the scam was exposed, the market rapidly collapsed. Retail traders dumped their holdings in a panic. But a company's underlying value does not disappear just because its stock price plummets. So he started buying heavily discounted shares. A similar pattern played out around the year 2000 with the dot-com bubble. The public poured billions into any company that promised to be part of the new digital revolution. The bubble burst, and the crowd declared the IT sector entirely dead. Saxena realized that India's digital automation was just beginning. He accumulated massive positions in high-quality tech companies, like Infosys, for roughly 100 rupees a share. Then came the global meltdown of 2008. Portfolios across the world were slashed in half, and fear completely dominated the trading floors. Instead of joining the panic, he looked at what a growing nation requires to function. A rising population needs a strong credit and banking system to expand. He bought up deeply out of favor, boring banking stocks like HDFC, while everyone else fled. In 2020, global lockdowns and sensationalist news coverage drove the markets into a steep dive once again. People were trapped in their homes, convinced the economy was permanently broken. He systematically deployed more capital. Over 35 years of trading, a clear mechanical rule emerges. Sell your positions to protect your wealth when the public is celebrating, and buy aggressively when the public is in a recessionary panic. Selecting the actual companies to buy during these periods does not require complex algorithms. It is a simple, highly rigid checklist. First, skip business models you don't understand. Ignore AI or EV hype if you don't know how they generate cash. Second, look for a 15-year track record of consistent profit. Third, balance sheets must show low debt. Fourth, the management team must be trustworthy. Following this list results in a very boring portfolio, and that is exactly the point. Boring, predictable companies compound massive wealth over decades, while exciting, volatile stocks drain money from retail investors. We live in an environment built on instant gratification. You can get a meal delivered in 10 minutes and consume an entire story in a 20-second reel. When you carry that demand for absolute speed into the stock market, you make fatal mistakes. Taking a loss and deciding to revenge trade to win it back assumes the market cares about your feelings. Treating the financial system like an ATM that owes you a refund is a childish fantasy. The market is a highly efficient, unemotional machine designed to take capital from the 90% of participants who cannot control their impulses and transfer it to the quiet, disciplined minority who can sit on their hands. So if you are trading right now, look at your own behavior. Can you endure a highly repetitive, thoroughly boring process month after month without requiring the thrill of a sudden gamble? You cannot order patience online, and there is no secret chart pattern that will fix a lack of emotional control. The stock market does not pay out for strategy. It pays out for maturity, discipline, and character.